For 3 years, everyone begged one building for one favor. Last September, the building said yes. Rate cuts. 3 of them. 75 basis points. 7 of them reached your mortgage. In the next 13 minutes, which of your numbers the Fed really moves, which ones it never touched, and the one person who won by refusing to watch. You got your rate cuts. The Fed cut interest rates 3 times. Barry's mortgage quote went up anyway. September 17th, 2025. The first cut in 9 months. Barry has been waiting 3 years for this exact moment. By Christmas, the Fed cuts twice more. 75 basis points. Everything Barry asked for, delivered on schedule. In March, Barry walks into a mortgage office to collect his reward. His quote is higher than it was in February. Nobody lied to Barry. He just spent 3 years watching the wrong number. This is the story of the most requested favor in modern finance. For 2 years, everyone, homebuyers, politicians, guys with podcasts, begged the Fed to cut rates. Then the Fed cut rates 3 times. And almost nothing anyone wanted got cheaper. By the end of this video, you'll know exactly which of your numbers the Fed actually touches, which ones it never touched, and why the people who begged the loudest got the least. And if you've been waiting for rate cuts to buy a house since 2022, Barry is you, we changed the name so you'd keep watching. So, what did everybody get? The federal funds rate, the thing everyone was begging about, is the price banks charge each other to borrow money overnight. That's it. That's the entire product. When you hear the Fed raised rates or cut rates, they're adjusting the price of the single shortest loan on earth, money that leaves after breakfast. You cannot buy this product. Your bank can. You cannot. Everything else, your savings yield, your credit card, your car loan, your mortgage, is downstream. Some of those lines light up within a week, some take a year, and one of them, we'll get to it, barely connects at all. Credit cards ride the prime rate, which is the Fed's rate plus 3. Mechanical, automatic. Savings accounts reprice at the speed of a push notification. Hold that thought. It comes back to hurt Barry later. 2022. Inflation peaks around 9%, and the Fed slams rates from 0 to over 5 in 16 months. Then it parks there, long enough for the entire internet to demand a pivot. A few cuts arrive in late 2024, then 9 months of nothing. By last September, the begging had a countdown clock. Then it happens, September 17th, a quarter-point cut, down to a range of 4 to 4.25%. October 29th, another quarter. December 10th, a third. The range lands at 3.5 to 3.75. 3 cuts in 3 months. All of it in the Fed's own statements. No leaks, just minutes. A basis point, by the way, is 1/100%. The finance industry invented a smaller unit so the numbers would sound bigger when you multiply them back. Every meeting of the Federal Open Market Committee, the FOMC for those of you who schedule your week around it, was covered live by guys like Devin. Greet Devin, 2.1 million subscribers. Every FOMC day, Devin posts an emergency video. He schedules the emergency 6 weeks in advance. The emergency is on the calendar. When the September cut hit, Devin called it the beginning of the greatest wealth transfer in human history. He also said that about the previous meeting, where nothing happened. Barry watched every stream, because Barry had a plan. The Fed cuts, mortgage rates follow, and somewhere around 6%, Barry finally buys the house. The plan had one flaw. The Fed doesn't set mortgage rates. The Fed sets the price of overnight money. Everything else in your financial life is a rumor about that number. Your mortgage rate doesn't answer to the Fed. It answers to the 10-year Treasury yield, the price of lending the US government money for a decade. The Fed is the building super. It can adjust the thermostat in the lobby. The 10-year is the landlord. The landlord sets the rent. And the landlord's rent is set by bond investors betting on the next 10 years of inflation and growth. Not the next meeting, the next decade. Barry's math was simple. Mortgage quotes were running 6.5. The Fed cuts 3/4 of a point. New mortgage, 5.75. And his alert was set just above it, at 5.99. Barry laminated it. Barry was proud. Here's what actually happened. In February, the 30-year touched 6.09. Barry's alert was set at 5.99, It never fired. 10 basis points. Then the line turned around and went the other way. By July, Freddie Mac's weekly survey had the 30-year at 6.43%. And here's the receipt nobody claimed. The week before the first cut, the 30-year averaged 6.50. So the Fed cut 75 basis points, and your mortgage got 7 of them. Barry's discount never shipped. Because here's what Barry heard when the Fed cut. Money is getting cheaper. And here's what the bond market heard. The referee just left the field while the score was still close. If investors think cuts came early while inflation was still breathing, they charge extra to lend for 10 years. That charge has a name, the term premium, and it lands directly in your mortgage quote. Cutting the overnight rate to lower a 30-year mortgage is like paying off a credit card with a slightly bigger credit card. It works, briefly, and then it really doesn't. Meanwhile, remember the thing I told you to hold? One of Barry's numbers did respond to the cuts, instantly. His high-yield savings account. The yield that had been paying him to wait, repriced down within days of each cut, all 3 times. The bank never misses that memo. There's a rule of banking physics here. Rates they pay you fall like anvils. Rates you pay them fall like a feather in an elevator that's going up. So Barry's reward for waiting got cut 3 times, and his waiting target went up. He responded the way every rate watcher responds. He kept waiting. We'll come back to Barry. There's also Nora. Nora doesn't know any of this is happening. Nora comes back. She doesn't know that either. Barry's scoreboard, 4 months in. The Fed cut 3 times, exactly as requested. His savings yield fell within days, every time. His mortgage quote went up. And the one loan that got cheaper, overnight money between banks, is a product Barry is not allowed to buy. Which leaves a question Devon's comment section never gets to. They're busy asking about the hoodie restock. If the cuts were this useless to the people begging for them, why did the cuts stop? March 2026. An armed conflict in the Middle East sends oil up. Energy is the one tax nobody votes on. The receipt prints at the pump. Energy prices climb. And energy is the one input that's inside everything. Shipping, food, plastic, flights, which means it doesn't stay an energy story for long. Devon covered the gas spike from inside his car for authenticity. By the May inflation print, headline inflation is running 4.2%. Core, food and energy stripped out, 2.9%, both moving the wrong direction. Now the Fed's problem. Monetary policy works on a lag of 12 to 18 months. Cutting rates is steering a cruise ship. By the time you know you turned, you already turned. The wheel got turned in September, October, December. The ship was still answering the turn when the weather changed. And then the captain changed. In May, Jerome Powell's term as chair ended. The Senate confirmed Kevin Warsh by a vote of 54 to 45, the closest vote since senators started confirming Fed chairs. Warsh arrived, looked at the inbox, and held rates, the Fed's 4th straight hold and his first. Then he retired the Fed's habit of telling markets what happens next. No more forward guidance. You find out when everyone finds out. Then came the June projections. In March, the median official expected more cuts this year. In June, the median moved up, and 9 of 19 officials now pencil in at least 1 hike. The consensus went from more cuts coming to maybe a hike in 6 months. These forecasts steer trillions of dollars, and they have the shelf life of bleeping potato salad. Devon covered the reversal the way Devon covers everything, as the biggest story in the history of stories, brought to you by a hoodie. So hold the full picture up to the light. 75 basis points down, the thing 2 years of begging asked for. The number Barry cared about went up anyway, and the same institution that cut is now hinting at the opposite. Everyone got what they wanted. Nobody got what they meant. If you want the uncomfortable version of why, bond investors are pricing your mortgage against 10 years of future inflation. 10 years. Half the people demanding cheaper money aren't pricing anything past the next fundraiser dinner. And to be clear, that's not one party. Every White House in living memory has wanted lower rates on its watch. It's in the job posting. The Fed exists to be the one employee whose whole job is disappointing everyone at scheduled intervals. Which is why the chair gets a 4-year term and a confirmation fight instead of a campaign. Meanwhile, Nora. In 2021, Nora looked at exactly one number, the monthly payment. decided it fit her life, and signed a 3% mortgage. Then she closed the laptop and never opened a rate chart again. She automated her retirement contributions. To this day, she believes FOMC might be a soccer club. Over the same 3 years Barry spent watching the Fed, Nora watched approximately nothing. Nora is winning, and it isn't intelligence. She just never enrolled her life in a forecasting contest. They turned the wheel in September. The ship answered in March, straight into a headwind nobody charted. That's what steering something this big always looks like.
So what do you do with this? One idea, and it fits on an index card. Match the rate to the number it actually drives. Fast lane, savings yields, credit card rates, home equity lines. These are roped directly to the Fed. When the Fed moves, they move within weeks. If the Fed cuts again, your emergency fund yield is the first casualty, not your mortgage. Slow lane, mortgages. Roped to the 10-year, which answers to a decade of expectations, and nothing about a decade can be scheduled. Waiting for a Fed meeting to fix your mortgage rate is waiting at the wrong window. Which brings us to the real math of Barry's 3 years. While he waited for 6%, rent went out the door every month, and the houses he refreshed at midnight got repriced upward underneath him. The cost of waiting for the perfect rate is the one line item no laminated card ever shows. Here's the version that still works after the dots flip. Buy when the payment fits your life. If rates ever truly fall, refinancing exists. Ask Nora, that's the entire play she ran. That's the whole strategy. It's boring and it requires knowing nothing about what the Fed does next. Because if your plan requires correctly predicting the dot plot, the document that reversed itself inside 6 months, you don't have a plan. You have a subscription. The gap between Barry and Nora was never information. Barry had more information than his own mortgage broker. The gap was that Nora's plan didn't need any.
Barry's still watching, by the way. Same kitchen, same midnight. The whiteboard got updated. He's early on the hikes now. He'd want you to know he's early. The Fed meets again at the end of July. Devin has already scheduled the emergency. There's a backup emergency on Thursday in case the first one holds rates steady. The Fed controls one number, the price of money that leaves after breakfast. It was never going to remodel your life. That was always on your side of the counter. See you at the next emergency.